Hello traders, Gary Wagner here just after 12:30 in Honolulu, 6:30 in New York. It is Thursday, 9th day of July, 2020, and this is the Daily Report for Gold and Silver. We had a mixed bag across the board in the precious metals, with gold and silver taking moderate hits on the day. Those lower pricing did take gold back to about 1808, 1809 right now. This, of course, is basis the August futures contract. On our show, we'll look at our technical studies to talk about our exit strategy, our upper level forecast, as well as the current move down and whether or not there was any technical chart damage, which you will see there was not, which is why I remain extremely bullish. We'll look at those charts in a second, but first, to the price board. Traders, we have seen gold move higher. We have had 4 consecutive green candles as it moved and traded above $1,800 an ounce and then went to an intraday high of approximately $1,829 the other day. Today's high, $1,825. We did see a round of profit taking, but as you will see during our technical studies, we have sustained no major chart damage and remain extremely bullish. Currently, 1807.70, that is down $12.90 on the day, and this, of course, is August gold. When we look at spot futures, that lost about $5.40 and is at 1803.10. The key to both markets is the fact that they closed above $1,800 per ounce. Platinum did sustain a drawdown, 3.5%, $31,852. Palladium gained about 1.25% on the day, $1,963, and silver lost about 0.75%. That is trading at $19.02 after a 14-cent decline. We are also watching Nugget as well as GLD. Those are the electronically traded funds we've been watching. That lost about a percentage, 0.8%, 87.40, and GLD lost about 0.25%, and that's at 169.63. Now, we did have dollar strength, and that provided some pretty strong headwinds in terms of moving the precious metals higher. They definitely worked against it. Let's take a look at our technical studies. Today, for the first time in 4 consecutive trading days, we saw the market move lower. The net result was a red candle, but I don't believe we sustained any technical chart damage, and I am clearly still very bullish on the market. Currently, we are trading at 1807 to 1808. This represents Australia as it opens up. But the key to me is 2 things. First of all, when we look at a trend line created through the lows that we have seen recently as this market has moved higher, what we can see is that in no way did we even challenge this particular trend line here. The second thing is that the key and psychological level that we broke just the other day of 1800, that would be this green candle right here, that has held because the low today came in just at around, I believe, 1799.90, but very, very close to 1800. And so that tells me that what was formerly a major resistance area has now become support. My recommendation is obviously to maintain our current long position and stop. For subscribers that have joined us recently and haven't positioned themselves in the futures market, we do have another opportunity in which you can get in roughly at the same prices we are currently in. You would place your stop at the very same place we recommend on the members page. And our long-term forecast has not changed at all. We are basing it upon Elliott Wave and a Fibonacci extension. We've been talking about this over the last couple of weeks, but we are still looking at the potential for this market to move to about 1920 at the conclusion of the rally. But that is with one rather large caveat, and I'll express that in 1 second. We're using this count as our wave 3. We are looking at a correction which ended down here and labeling it as a wave 4. And then from there we do our 0.618% extension of this wave, and that takes us to 1920. Here's the caveat. This is a 5th wave. A 5th wave will, in fact, be a series of peaks and valleys. Where that market will stop before a wave 1 concludes is not as easy to forecast as waves 2, 3, 4, and 5 because they're pretty much all based upon the first wave, with the exception of wave 4, which is based on wave 3. That being said, I would look for this market to have a correction, one shallow, one deep, and we are looking for a series of 5 waves to achieve this 1920. So I don't want you to think it's going to be a straight up move, but nonetheless, this is where we are looking for gold pricing to conclude by the conclusion of this rally. And traders, I do want to take a look at silver today. Silver has had a phenomenal run up. It has broken above a key level of resistance, much in the same way that we saw gold break above 1800. If we take a look at this chart, this represents roughly $19 per ounce. We can definitely see this top right in here that confirmed this being a strong level of resistance. It matched this top here, which of course came before this dynamic fall, taking silver under $12 an ounce. And we also see a parallel in the way silver moved when compared to gold. And what I am referring to is once the market hit these lows below 12, it quickly recovered. It came up to about $16.15. That was a 0.618% retracement from this high to this low. It then retraced slightly and then moved back up. But here's where the parallel comes in. We can see that effectively we saw silver trade in a range that contained it between about 1750. You did get a couple of lows that came just below it, and with the high at about 1900. The fact that it broke above 1900 yesterday and then came down today but closed right at 19 and is trading currently at 1902 tells me that this rally could in fact still be intact as far as silver goes. As you know, we are looking for silver to go to approximately $21 per ounce. That has been our forecast over the last 2 weeks. Maintain your long position in Nugget. That did lose a little bit today, roughly 0.85%. And also maintain your long position in GLD. That lost about 0.25% in trading, and that's at 169.63. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.